The Lao Street gained for 9 straight days, the longest winning streak in close to 30 months. For the week, the market saw green for the third consecutive week. Financials outperformed, while mid-caps rose in line with the blue chips. On today's edition of Editors Roundtable, we put the spotlight on IT stocks, the Q4 performance. We decode the AU Small Finance Bank rally. We also take stock of whether active funds can make a comeback. Welcome to Editors Roundtable. I'm Reema Tendulkar, and with me I've got Nimesh, Nigel, Prashant, and we've got Mihir, Vora as well with us. Hi guys, starting ERT later than usual this time.
And you've had a busy day, right? TCS in the morning, Infosys right now, and running all the way to this now.
Got a good long weekend coming up, Reema. You can take a good rest.
I'm going to rest.
But things are looking better, right? Much better. The markets are looking better. And I just realized that with the market rallying 1,000 points from the lows, we are just 4% away from all-time, 4.5% away on the bank nifty from all-time highs, and about 6% on the nifty from all-time highs. So actually,
but if you ask the market guys, I mean, have they participated in the rally or have they made money? The answer is no. There is still a lot of skittiness. There is still a lot of, the sentiment is still skittish.
More or less, right? So no, that's the other thing, right? People who are invested, Nimesh, right? Fully invested. Correct. I mean, people who take big cash calls, I think for them it is different. But for a lot of people who are institutionally fully invested, I think,
what I meant was that this rally is on back of a lot of disbelief. People have participated, but they've just like been in and out very quickly. There is no hard conviction to just hold on and rally this whole 1,000 points. So it looks like on paper looks good, 1,000-point rally from the lows. But if you ask the market participants down there, even the traders and all, they've not participated too much.
What was the genesis of this 9-day rally? Because the RBI pause only came towards the end of last week.
Yeah.
The US inflation only cooled off this week. So what was the genesis, from 20th March to rally all the way now 1,000 points? Flows, that's why.
Valuations.
And also the March end phenomenon got out of the way, right? Even that helped a bit of rally in the
we were talking about that, I think, even before SVB. The entire SVB thing happened in the middle of March. I remember on the 8th or 7th of March, it was a Friday, SVB had not had not happened. And we were saying, I remember right here, we were saying that it's maybe time for a bit of a rally. And then SVB happened and the market took another leg down. And at that point, after the lows, I mean, the Nifty was trading at 17 times as compared to the 10-year average, which was about 17.3 times or so. So it was close to average valuations, at least for the last decade or so. Let me just quickly tell you, what Nimesh and I were discussing, the rally and what this means for stocks, right? I mean, at the end of the day, if you own these stocks, you've made money. So this is a 1,000-point rally for the Nifty. This basically is a 1,000-point rally from the 20th of March. And the stock changes will come up on your screen. HDFC Life, Tata Motors, Divi's, Bajaj, IndusInd Bank are some of the big 10%, at least 10% and more kind of gainers. Losses, not very much. I mean, BPCL is down about 7.5% at this time. Tech Mahindra, HCL Tech, but that's about it. I sort of widened the scope of this and looked at the NSE 500 as well. For the broader market, both for the mid and small cap indices, the low was not 20th of March, it was 28th of March. And here also, I mean, these are not the Page Industries or those kind of high quality names which have rallied. The names which come right at the top of the list are things like Fact, which is the fertilizer company, Dhani Services, Balaji Amines, completely forgotten name, rallied about 30% in this time period. A lot of real estate, Godrej Properties has done well, DLF has done well, Deepak Fertilizer, IDBI, IEX. These are kind of, some of the names which have rallied. Now, we can say how many people really would own this or already own this, but these are the ones which have done very well. Now, what next is the question? The banks index is clearly outperforming what the market is doing. It is now basically, as I said, only 4.5% away from all-time highs. And technically speaking, it's crossed the 61.8% retracement of the entire fall from the all-time high to the recent low. So technically, there is nothing which stands between where we are now on the Bank Nifty and the all-time high. The Nifty is just under that 50% retracement, same retracement from the all-time highs to the recent low. And there, the next target is the 61.8, which is 18,100 for the Nifty. Fourth quarter earnings commentary, I mean, I think we'll discuss more about Infosys in just a bit, but that remains key to watch. After third quarter, we saw so much in terms of downgrades. Will we see a repeat this time again? After fourth quarter is the question. And the global picture, I think it's anybody's guess. It's a toss-up right now. there are those who believe that the economy is still running very hot in the US, which means there are Citi, for example, they are of the view that we will see 3 more 25 basis point rate hikes. And on the other side, there are those who say, maybe it's just one more by the Fed, and then there is a long pause, and then there are 80, 100 basis point worth of cuts in the latter half of the year. So it's split down the middle between those who believe that things are hot and things are very, very going to get very cold very fast. So, I mean, just to summarize things as they stand right now, Nimesh, what are you picking up?
So Prashant, we spoke about the 1,000-point rally and the fact that it all happened on back of disbelief. But the other good important point is this rally was backed by FI buying as well. I was talking to some large investors, and the feedback is that India seems to be back on the global radar, and there are a lot of long-only funds who are looking to now buy into Indian market. In fact, one of the big global investor who's been in the news of late, he was in India last week, and he actually met a lot of companies, and he's actually closed some blocks as well. So there is interest back in quality names from the larger FI. So that's the overall feedback. The other interesting thing was a big debate between banks versus IT, and we'll ask Mihir as well about that. But again, the street seems to be quite divided. There is one set of investors who believe that within banks the best is in the price. And now you'll see some challenges in terms of NIMs and also whether it's time to sell or just to hold on. And on the other side, on IT, while we saw the TCS numbers weak, Infosys was a howler, but there is a section who believes that this would be the last worst quarter, and from here on one needs to pile on. So it's again a bit of a debate between banks versus IT among lot of large investors. So that's something I picked up. And the other interesting thing is within banks, now investors have started betting on the laggards of last year. Look at HDFC Twins, Kotak Bank, IndusInd Bank. They all seem to be back on the radar now, and people are looking to buy as well. In fact, one of the long-only fund did buy a large chunk of HDFC Bank this week before the earnings coming in over the weekend. So again, that's something within the banks. You will see a bit of churn. So that's something that I've picked up. The other interesting thing is the broader market seems to be back, and there is now a bit of interest back. The fact that post April 1st, we saw a good pullback rally in a lot of the beaten down mid caps and small caps. So again, that was something a bit of a relief, but that needs to be seen whether that can continue, because earnings are going to be very important. But broadly, the 1,000-point rally is backed by FI buying, and India seems to be back on the investor radar purely from the fact that we've underperformed in first quarter and the valuations have turned a little attractive now.
After short covering by FI.
A bit of short covering.
Nimesh, by all record shorts.
Mihir, by all yardstick, this has been a very shallow. I mean, I was looking at even the small cap index. Nigel, you and I have been talking about this, how broader markets have corrected. But by historical standards, you'll go back and see the last 3-4 large dips. Small cap index corrects 50-70%. I mean, this time the correction was on that index also, what, 20-25% or so, right?
Correct, yeah.
So it's been, and on the Nifty, it's been even lesser.
But no, that way even Nifty did not correct that much.
Exactly. So it's been a shallow kind of a correction which has come back very, very fast.
And the point on the shorts, right? I mean, we were sitting at 1.5 lakh short contracts.
By FIs
short contracts
alone,
by FIs. That was the highest that we've ever seen. I think they almost went to around 200,000 as well, 1.97 odd.
Yeah.
In 20 days, I think they're back to almost neutral.
They're back. I think now the net short position is down to 45,000 contracts. So 1 lakh contracts that have got covered on the short side. So that's another big factor. Besides valuations, besides flows, a net short market always gives you that additional reason why the markets will go up. Just a glimmer of good news, and you will see that.
But ask Reema about the bad news from Infosys. Reema.
Well, IT earnings have not gotten off to a good start. So this week we had numbers from TCS and Infosys, and both of them have missed the mark. So TCS was a miss on revenues and margins, but Infosys was a howler. It was a shocker. It was a big miss on both revenues and margins. Let's run you through the key numbers this time. Now, on the top line, the constant currency revenue growth, the number to focus on is minus 3.2% by Infosys. There was no estimate on the street which expected a big decline of more than 3%. TCS also missed the mark, just a 0.6% growth, but at least they managed to clock in a bit of a modest growth. Infosys' decline of minus 3.2% is the worst that I've seen at least in 10 years. And even in COVID, post-COVID, there were 2 quarters where Infosys revenues had declined. But even at that time, the revenue decline in Infosys was not this significant. Margin performance too, for both Infi and TCS was a miss. For TCS, margins were flat. The hope was for margin expansion. For Infosys, the hope was margins will be flat, but they actually declined by 50 basis points. Now let's move on to the outlook, the FY24 guidance by Infosys. There are just 2 IT companies who give you a numerical guidance. One is Infi and the other one is HCL Tech, which is why we look at Infosys guidance so closely. 4 to 7%. And look at the big come-off compared to the kind of growth it's clocked in FY23. Margins of 20 to 22% versus 21%. Both these parameters have come in lower than expectations. Remember that last year, that's FY23, the companies footed a very large wage bill on account of bonuses, the war for talent, the need to hire, premium subcontracting costs, greater subcontracting costs and premium laterals, as a result of which the cost had ballooned. The expectation was that next year, FY24, the supply side situation will start easing because companies have stopped hiring. In the case of Infosys, their headcount has actually come down. Attrition is easing. So therefore, margins should have improved. But going by the guidance, it doesn't look like margins are improving. Now, let's tell you what went wrong this time. In the case of TCS's North America business, the management clearly said that at the beginning of the quarter, we were anticipating North America to grow. But North America declined by 0.8% on a quarter-on-quarter basis. Discretionary spends were put on hold. In the case of Infosys, the company said that it was not just BFSI. They saw unplanned project ramp downs in other verticals as well. So the problem isn't just with BFSI. They saw it in the case of telco, high-tech, retail. In particular, in mortgages, they also saw it in asset management, investment banking. They spoke about project cancellations as well and some client-specific issues. And the management also went on to say that while they've seen some stabilization in the environment in the month of March, it's still very uncertain. The hiring numbers also give you an indication of the demand trends. In the case of Infosys, the headcount has actually fallen by 3,600 on a quarter-on-quarter basis, while attrition, that's the silver lining. There are two silver linings. Attrition is falling, and the other one is the order book number, and attrition has come down. A quick word on the valuations as well as where the stocks and how they've currently positioned. Well, between the two, Infy actually underperformed the Nifty IT index, and TCS is down 8%, but it's still trading at a valuation of 21 times. So the question right now is that if IT companies are growing at 4 to 7%, which is what the Infosys guidance is, and if margins are not really expanding because there is no operating leverage without very strong growth, what is the kind of valuation multiple we need to ascribe to IT companies? Mihir, that's the question, right? We keep saying that IT companies have fallen quite a bit from their post-COVID high valuation multiples. They're actually not very expensive compared to their long-term averages, little expensive. But if growth rate has fallen off to, by a cliff, what is the right valuation multiple?
Reema, we've seen not only in tech, but across sectors, earnings momentum and the upgrade direction goes along with valuations. So when you see earnings getting upgraded, you see valuations also moving higher and higher, and vice versa. So I think I'm not very finicky about absolute valuations in any sector, not only IT. I am more finicky about the direction of the earnings momentum. And in the case of IT, it clearly looks like we are in for a negative earnings upgrade, or rather earnings downgrade cycle. Yes.
And how bad could it get, the earnings downgrade cycle? Are we closer to the bottom in terms of the bad news?
I don't think so. I mean, maybe we are, but I would not call the bottom now, because I would typically look at the US economy, and I'm reasonably sure that we are not past the woods as far as the US economy turnaround is concerned. Probably things may get worse before they get better. And if you look at all the data points, the one data point that I would look for as a good signal from Indian IT companies is the hiring. Not the order book, nothing else, is the hiring. And if you see for the last couple of quarters, hiring has been flattening off, which means that companies are really, cynical or skeptical about the next 3 or 4 quarters as far as the ramp up of demand is concerned. So while order books are there is still order wins. There is always a chance that orders can get elongated or postponed or even cancelled. So the hiring number, if you see for the large companies, has been quite flat for the last.
So you stay underweight, and you think things could go worse.
Also because of ChatGPT, right?
ChatGPT is another threat, but probably.
Do you think it'll really explode into something? I mean, it's not just ChatGPT, because everybody's trying their own ChatGPT, right?
Sure.
And the news flow, at least there, has exploded, and it's all under the surface.
Yes.
With IT companies. Although TCS, I think, did tell you, Reema, in the morning that with clients, that's the conversation which is happening.
Correct.
Can it really be a big threat, according to you, from what you're reading, what you're
At least from the initial, readings, it looks like it can be a big disruptor. I think threat is not the word; it's a disruptor.
Sure.
Because you can have people being able to write code without knowing coding. And the level of kind of layers of intelligence that are being built in even as we speak, and we are only talking about Chat 3.5.
Yeah.
GPT-4 is even like multiple times powerful, and apparently in December we'll have GPT-5, which can be used for multimedia inputs and outputs. So I think it's a big threat, and in the next 1 or 2 months I think I'll be able to form my views. But right now it can potentially be a big disruptor. Yeah.
All right, I think we have gone on enough about tech. So let's talk about the banking space. Nimesh, AU Small Finance Bank, the top boss get an extension of 3 years. The street liked it in a single day. Stock was up 15%. Tell us more.
So clearly, the AU Bank was the stock of the day and the newsmaker of the day as well. So it rallied 17% in one single day on the back of the announcement that Sanjay Agarwal has been reappointed by RBI as MD and CEO for the next 3 years. And that was one trigger which the investors were watching out for very, very closely. In fact, within the financial, this is the year when they are going to see a lot of such announcements to track. The next to track would be City Union Bank's, Kamakodi's appointment, which will come up for renewal on May 1st. So that's something to track. And also by end of the year, you'll see about Uday Kotak's reappointment as well. So basically, a new CEO in Kotak Bank. So that's something to track within the financial. So I was just looking at, both AU Bank, which got an extension today, and the fact that, last month, we saw the reappointment of Sumant Katpalia as the MD and CEO of IndusInd Bank, though he got only 2 years versus the board expectation of board had asked for 3 years. So let me just run through the journey of both AU and IndusInd Bank since they've been taken over. So look at AU Small Finance Bank first. As I said, the news is the current MD and CEO has been reappointed for 3 years, so that's good news. But if you look at the numbers, NPA in March 2020, when he was the MD and CEO, he's been a promoter since inception. So the NPA then was 1.7. During COVID times, it went all the way up to 4.1. Now it has fallen back to almost 1.8. Even in terms of strength, the company's strength has gone from just 5,000 employees to more than 30,000 employees now, and the independent board is largely being controlled, and there are some 8 independent directors on the board as well. So it's fairly independent as far as the board is concerned. Even the liability franchise has done very well in the last couple of years. So from 26,000, it has gone all the way to 70,000, and even the CASA has improved for AU Bank from 14% to 38%. So all the metrics look very good as far as the numbers are concerned over the last couple of years. Even if you look at the equity fundraising, they've done 2 fundraisings in the last couple of years, one in 2021 and one in 2022. And having said all this, the market cap of AU Small Finance Bank has been pretty much stagnant for the last 3 years. Since the last appointment to this one, the market cap has been pretty much in the range between 40 to 45,000. So not much has happened in terms of stock price in that period. Now look at IndusInd Bank. We saw the announcement of Sumant Katpalia getting reappointed for 2 years, and that's got confirmed last month. So even if you look at IndusInd Bank's key matrix, capital adequacy ratio has improved, credit growth has improved. If you look at the ROA, that was negative, that's come to positive now, 1.87%. ROA has improved to almost 15.2%. And even IndusInd Bank in the last couple of years have done 3 or 4 fundraising, 2 equity fundraisings, as well as a couple of debt funding as well. Even if you look at IndusInd Bank's market cap journey in the last couple of years, it has rallied from almost 70,000 to all the way up to 83,000. So a bit of 15% rally we've seen in the last couple of years since Sumant has taken over. So it's been a quite good journey for both these banks on the back of the new appointments. But if you look at, the good part is age is in the favor for both these CEOs. Sumant is 60 years old, and for AU, Sanjay Agarwal in AU Bank is just 52-year-old. So age is going to be in their favor. And if these extensions continue, you might see further re-rating in these stocks. The fact that they've relatively underperformed, there is a scope, and this is what a lot of investors are going to like, the fact that there is extension and edges on the side for them to continue for more years. So that's something to track both in AU Small Finance, as well as in IndusInd Bank.
Nimesh, if you remember, in AU's case, it was like the stock to own, right? When it came to the market. I remember
even it's been one of the expensive banks, so to speak.
It has been. It was actually very expensive at one point in time, and was touted as the next HDFC. I remember this Deepak Parekh at one of the events around the time of listing, etc. So, maybe the good times are back. We'll take a very quick break here. Mihir is with us. We'll pose the bank's question to him, and of course we'll have Nigel take us through how active funds are performing and whether they have a chance against index investing. Stay tuned.
It's okay for us to nod for everything. Because we are parrots. But your wealth manager?
And CEO of GetVantage.
वोकल फॉर लोकल का नारा अब एक ही लक्ष्य हमारा आत्मनिर्भर बन जाने को अपनाएंगे Z।
Register for MSME Z certification today.
Welcome back here, tuned into Editors Roundtable. Well, before we move on, Mihir, I wanted you to get your view on this space. You know, SPIVA, they came out with the note, and SPIVA basically, they compared the performance of actively managed equity as well as debt mutual funds with the benchmark index. And, you know, the key finding out here is there's been a big underperformance of actively managed funds if you compare it with the indices. And they've looked at both the segments. That's the large cap. In 2022, that was up by close to 6% odd. And 88% of those active funds, they underperformed. It's getting a little scary, right? And from the broader markets, that's the small and the mid-cap funds, well, that index was up to 3% odd. But the underperformers were nearly around 55%, you know, in comparison to the benchmark indices as well. The question is, will active funds now make a comeback? You know, because at times of volatility, it provides the best opportunity. In a growing economy like India as well, you'll get those select stocks that will do quite well. And this period of underperformance from active managers or active funds could be coming to an end. I was looking at the flows as well. Incremental money has been going to passive funds because of this underperformance of active funds. Mihir, I want your comment on this. Do you think the time has come? Because, you know, you wait for those few years. It just requires 1 year to get this entire underperformance, you know, outdone.
So asking for a self-appraisal.
If you want to take it that way. I try to put it subtly, but what do you think?
No, see, it's always, I've been here for long enough to figure it out. Hopefully I know something about it. One is, it's always easier to outperform in a trending market.
Yeah.
So if you look at the big periods of outperformance by active managers, it's periods like 2003 to 2008. Big outperformance, you know. From 2014 to 2018, significant outperformance. From the bottom of 2020 till say about the middle of last year, there was a period of outperformance. So it's easier to pick stocks and trends in a trending market. So that's one. Second is, I think, if you look at the trend again, these are also the periods where mid caps and small caps have done better.
Yes.
So when the mid cap and small cap space is, you know, working well, you always have the, you know, asset allocation to spice up your portfolio to put something into the mid and small cap space, even though your mandate might be dominantly large cap. So that's extra kicker comes from the middle and small cap space. But that confidence you typically have when the markets are reasonably bullish or at least not negative. If you look at the sharp periods of underperformance, it's basically periods like 2018 to 2000, almost 20, almost 2 to 3 years where the mid and small caps got really smashed, you know, in that period. So I think it's easier to outperform when it's a stable and a reasonably rising market. Periods of choppiness tend to, you know, bring out the underperformance patches. That's one. And second is, I think inherently most fund managers are growth biased. Yeah. So if you look at specifically the last 1 year, growth has underperformed value.
Yeah.
Right. The value stocks have come back after a long time. The commodities, the cheaper PSU banks, for example.
ITC.
Yeah. So the point is that inherently, I think we are genetically growth investors. Maybe growth at any price, some are growth at a reasonable price. But those are the kind of characteristics I would say. But in the long term, if the Indian economy is to be considered as a growth economy, then I think there is enough scope for stock selection and, you know, to generate that output.
Nigel, by the way, that data includes fees or doesn't include fees? That's the golden number.
It should include fees, of course. Yeah, it's post fees, of course. So fees, of course, is a big drag. So that's to beat the benchmark. Yeah.
Okay, gentlemen, we're out of time on this Thursday special Editors Roundtable. Enjoy the rest of your long weekend. But stay with CNBC TV18 as well, because lots more news and updates will be coming through after this short break.